This is Barry Zalma speaking for Claim School Incorporated's blog, Zalma on Insurance. Today we're going to speak about why it is necessary, if you wish to sue for fraud, to have evidence, and an insurer is not required to disclose how it selects its premium and its policy limits. Ira Trocki sued Pennsylvania National Mutual Casualty Insurance Company for fraud related to certain insurance policies. The district court granted summary judgment for Penn National, and Trocki appealed. In Ira Trocki v. Penn National, the Third Circuit Court of Appeals on September 13, 2023 explained what is needed for a plaintiff to prove fraud. Trocki, the owner of a real estate development and management company, purchased and renewed commercial insurance policies with Penn National through an insurance broker from 2006 to 2014. Prior to each annual renewal, Penn National provided Trocki's agent and Trocki with a renewal policy limit and premium to review. Trocki sued Penn National in federal court, bringing two claims for fraud, one for common law fraud and one for consumer fraud under the New Jersey Consumer Fraud Act, the NJCFA. Trocki alleged that Penn National actually increased its coverage limits and insurance premiums without notice, and that it was doing so to account for inflation. Trocki initially referred to this practice as inflation guard, but now contends that he meant to refer to the practice of applying an automatic inflationary increase. The parties agree that the inflation guard is an optional coverage benefit that an insured must purchase separately and was not applied to Trocki's policies. The district court concluded that Trocki fell short of making a prima facie case for either fraud claim. In discussing the law, the Third Circuit noted that summary judgment is appropriate only if the movement shows that there is no genuine dispute as to any material fact. There is a genuine factual dispute if the evidence is such that a reasonable jury could return a verdict for the non-moving party. All facts are to be viewed in the light most favorable to the non-moving party. Trocki argued that the district court improperly granted judgment for Penn National on his claim under the NJCFA and for common law fraud. The NJCFA prohibits certain deceptive commercial behavior, and for there to be a claim under that act, a plaintiff must demonstrate 1. Unlawful conduct by a defendant, 2. An ascertainable loss, and 3. A causal relationship between the defendant's unlawful conduct and the plaintiff's loss. A cause of action for common law fraud in New Jersey has 5 elements. 1. A material misrepresentation of a presently existing or past fact. 2. Knowledge or belief by the defendant of its falsity. 3. An intention that the other person rely on it. 4. Reasonable reliance thereon by the other person, and 5. Resulting damages. Trocki's argument was that Penn National applied some undisclosed inflation factor to increase the values of the properties covered by the Penn National policies. Trocki argued that the increase in building limit due to an automatic inflation increase is misleading and unclear in that it does not appear to apprise the insured of why the building limit and the premium is being increased. The Third Circuit concluded that the district court correctly found Trocki could not make a prima facie claim of common law fraud or consumer fraud under the NJCFA. To start, prior to the renewal of each policy, Penn National presented Trocki with what the new policy limit and premium would be, and Trocki had the opportunity to review and then, after doing so, paid the new premium. Under New Jersey law, there is no duty to disclose in a business transaction. Trocki was fully informed of the price and policy limits and Penn National is not required to disclose precisely how it reached those numbers. Trocki failed to show, at a minimum, either a material misrepresentation is required for a claim of common law fraud or unlawful conduct as required by the NJCFA, and therefore judgment was affirmed for Penn National. In my opinion, some people appear to believe that suing an insurance company is a perfect way to profit. Mr. Trocki renewed his policies annually, accepted the policy limits and premiums charged him, paid the premium, and then, after a few years, decided to sue his insurers because Penn National failed to explain the methods it used to set the policy limits and premium. I imagine if he had a loss, I doubt he would complain about the higher limits. The Third Circuit should have applied Rule 11 to this suit, since it is clearly spurious. This video was adapted from my blog, Zelma on Insurance, which is available free to anyone who clicks on the URL zelma.com/blog. If you found this video to be of interest, please tell your friends and colleagues about the blog and the videos, and let them subscribe. Subscription is free either to the blog or the videos or both, and the list is kept by me and given to no one else. You can subscribe to the blog and the videos, and if you wish further detail about insurance, insurance claims, insurance law, or insurance fraud, please consider, for a very small fee, subscribing to my Substack publications or my locals community. Thank you for your attention.